Hello, thank you, everyone. Going to talk about the real reasons to invest in gold. And, you know, gold is one of those things that everybody has an opinion about. That's the price of gold. That's a pretty good reason to invest in the price in gold right there. But, you know, the real reason, and if I only had, the reality is people invest in gold for two reasons. They invest as a way of preserving their wealth, and they invest to make money. And our view at CPM Group has always been that those are both legitimate reasons, and they're not mutually exclusive. You can have a portion of your wealth that you have in gold and in silver for capital preservation purposes, but you can have another portion that you invest in on a more opportunistic basis for capital appreciation. And you can keep them separate. So you buy gold because things happen. They happen on a personal basis. Something happens and you need capital, you need wealth, you need money. And things happen on a regional basis, a local basis, a national basis, an international basis. And gold is a good portfolio diversifier and way of reducing your exposure to any one currency that gives you protection against catastrophes. That's the capital preservation thing. And then there's gold as an investment, where you diversify your portfolio. And a lot of people think that gold trades opposite the stock market. But if you look at the statistical correlation of rising and falling stock prices versus rising and falling gold prices, the statistical correlation is something like 7%. Because a lot of times when the stock market's rising, investors in the stock market say, I want to rebalance my portfolio, and as the value of my stocks rise, I need to buy more gold to have the same percentage of my wealth in gold. Or they say, gee, the stock market's risen, and maybe it's going to fall, and maybe those crazy guys on the internet that say it's going to fall 30 or 50 or 80 or 90% are right. So it's a good time to diversify my portfolio and add some gold to it. And as a result, gold often rises when the stock market rises. And gold often falls when the stock market falls because of that capital preservation thing. Now, the value of my stock market holdings are down. I need to sell some gold to have cash to cover my situation and my position. So we look at gold for a variety of reasons. But if I only had one slide, and I originally thought this is the only slide I'm going to bring, and then we just open up for questions and answers. If I only showed you one slide, this is the one you need. This is what they call an efficient horizon. You start with a portfolio that is 50% T-bills, 50% S&P. So you're not saying, well, yeah, but you were a good, smart stock picker or anything. And then you add 5% increments in gold. And as you add gold, you can see the risk is the bottom, the volatility of your wealth. The risk falls as you add gold to your portfolio. And the return actually rises. That's the vertical axis. You actually have a better return over time, and this is actual data, month-to-month changes in gold, stocks, and T-bills, 1968 through 2020. As you add gold initially, your volatility gets down, your risk of your wealth being significantly reduced in total falls, while the returns of your wealth actually increase. And then you have a turn, and around the 25 to 30% place, you start seeing that your risk starts rising, even as your return continues to rise. And you cross around 25, 30%, you get to the point where your risks are now rising more than your returns. So you don't want to go over 30%. Now, guys did this in 1980s using data from 1968 to 1980. Gold price was free to float in 1968. And the curve, the sweet spot, was 5 to 10% of your wealth should be in gold. And from 1982 until 2016, when we updated the Ibbotson research, people said 5 to 10% should be in gold. When we updated it to include everything that had happened from 1980 forward, it was 25 to 30%. The real reason you own gold is because it protects your wealth and it makes you wealthier. But that's just buying and holding gold. You can do a lot better. These are our buy and sell recommendations on what we call intermediate term basis, 2 to 3 years out. Should I be a buyer? Should I be a seller? It starts in December 1980, the day I started as the head of commodities research at J. Aaron and Company. And the chairman said, so are you bullish or bearish on gold? And I said, bearish. So we had a sell signal on December 1st, 1980. And you can see from 1980 until 2000, about 68% of the time we were telling people, don't buy gold. If anything, sell it. That means 32% of the time we were saying buy gold. In November of 2000, we said buy gold. The world is becoming a much more hostile place, and it's going to be a much more hostile place, not for 2 years, but for decades. And we didn't issue a sell signal until September of 2012. We issued a buy signal a little bit too early, 2013, and we still have that in place. And if you had just taken our buy and sell signals and said, okay, I'll buy when Jeff says buy, but I won't sell short, I'll just liquidate my gold position, put the money in T-bills, and wait for the next buy signal, you would have had a much more dynamic return, as you can see here. Or maybe you can't see, because it's kind of blurry. But you can see from the bars, if you had bought and held, you would have doubled your money from 1980 to 2020, 40 years. If you had gone long but liquidated and waited for the next long signal, you would have done much better. And if you had gone long when we said go long and gone short when we said go short, you would have just knocked the ball out of the park. So if you just want to be a cautious guy and hold the stuff, you can have a really good return. It doesn't actually go back. If you want to just be a cautious guy and just hold the stuff, you can do really well. But if you want to put some intelligence in your wealth management, you can do much, much better. Now, these are the intermarket relationships. Gold versus inflation, 9%. Gold versus the trade-weighted dollar, 34%. Gold versus the Dow Jones or S&P, 4 and 5%. T-bills and T-bonds, 1%. Silver, 70%. That means that if you think that gold rises lockstep with inflation, 91% of the time you're wrong. If you think that gold trades only against the dollar, there's a very prominent billionaire who lost a lot of money by buying gold because starting around 2008, 2009, because he was convinced the dollar was going to collapse. And he's lost a lot of money because the dollar hasn't collapsed. It's actually up sharply from where it was then. And so is gold. It's a 34%, negative 34% correlation. So 2/3 of the time, if you're trading gold based on the dollar, you're losing. Dow Jones and S&P stocks 4 or 5%, T-bills, T-bonds 1%. This is a perfect portfolio diversifier because it doesn't move in opposite direction of these assets. It doesn't have a statistical correlation. So you're really diversifying your portfolio. We do a graphic thing. Why do you buy gold? Well, as an inflation hedge, as a safe haven, as a currency hedge, as a alternative investment, diversify your portfolio, as a commodity. And right now, it's our view that 3/4 of that, said we have a 75% weighting, a lot of those things, inflation, safe haven, portfolio diversification, are saying yes, 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 buy gold. And the other 3 are saying, yeah, it's sort of like halfway between buying gold and not buying gold. And nothing is saying gold's a bad investment right now. And you see that reflected in investment demand levels and in the price. These are our long-term projections for global economy. The big red line in the middle is the global economy. We saw a big recession in 2000, 2009. It came back. We saw the recession in 2020. It's come back. Our expectation is another recession, maybe 2025, 2026, and then it will come back. So when folks talk about, oh, the collapse of the dollar, the collapse of the global economy, the collapse of the treasury, we say, no, that's not how the world works. Things are good, then they get bad, then they get better, and then they get bad. It's 100% probability that there will be many more recessions in the future. You don't know when or how long or how deep, but history shows us that after a recession or a depression, you see a recovery. So it's not the collapse of all times. If you go back to the classic gold standard of the 19th century, the United States had depressions, not recessions, depressions, really big depressions in the 1870s, in the 1880s, and in the 1890s. And in between, they had periods of very high inflation, like 20% inflation, which we haven't seen since then. You know, the worst inflation was in 1980, 79, 80, and it was 14%. You can't see what this is, but this is a quilt chart. And a lot of brokers say, okay, on an annual basis, here are 9 assets, high, large cap, small cap, large cap, non-US, small cap, real estate, treasuries, non-treasury bonds. And they do this quilt chart and they say, what was the best performing asset last year? We added gold and silver because we couldn't find any brokerage house that had gold and silver in their group of 9 assets. And when we did that, we found out that 15% of the time, from 2020 to 2020, from 2000 to 2021, 21 years, 15% of the time, gold was the top performing asset. 15% of the time, silver was. In terms of the second best performer, gold was another 15% of the time, and silver was 5%. And at the third tier, silver was 15% and gold was 5%. Gold and silver are extremely competitive with other assets. You won't hear that from the marketing groups of gold and silver for some reason, but that's the truth. We've been doing this research for half of a century, and we're going to continue. Now, those were the reasons, the real reasons to buy gold. Here are some of the reasons that you ought not. No, these are some of the reasons that you should ignore. They're not reasons to not buy gold. They're reasons to ignore. Gold is said to be, as I said, a currency hedge, inflation hedge, et cetera, et cetera. But let's look at this. Currency hedge, 34% of the time, it trades against the dollar. The other 2/3 of the time, you're losing. You don't trade gold against the dollar, unless you want to lose 2/3 of the time. Some people are like that. Jaco Pastorius liked getting beaten up outside of bars, and it killed him ultimately, but you don't want to do that. Inflation hedge, it's 9% of the time. Doesn't mean that owning gold helps you during periods of high inflation. It does. What it means is that if you see inflation rising, don't necessarily expect the gold price to rise lockstep with it. Portfolio diversifier, I've gone through that. Safe haven, yes, it's true. Commodity, yes, it's true. But the biggest fundamental in the commodities, gold supply demand, is investment demand, driven by those other 5 factors, and a form of savings. Things that you need not fear. The dollar's not going to collapse. I mean, I hear people saying the dollar is collapsing. The dollar is up something like 20% from where it was 5 years ago. I heard a guy yesterday say that the dollar was collapsing during the Great Recession. The dollar rose 25% during the Great Recession. George Bush was not calling up governments asking them to prop up the dollar. Governments were calling George Bush and saying, hey, you're killing us with this strong dollar. It's just like, if you expect the dollar to collapse, that means you think that Europe has a better economy and society and economic system and political system than the United States. And if you think that, let me know where, because I want to move there. But, yeah, let's go to France. My father's family left France My mother's family left Italy. Governments are not planning a great reset, a currency recall, or anything else. You hear this over and over again. Oh, and now it's going to be, I think, May 20th. So like Friday, they're going to call in the economy, the dollar, and all of the other currencies. You know, yeah, you know, I don't know a single central banker or government official who has talked about a great reset or a currency recall. I only hear it from people promoting gold investments based on fear. There's a big publisher who actually publishes a lot of those guys' newsletters and online stuff. And they came to us in the early 90s and said, we think maybe we could publish a CPM group newsletter on precious metals. So we talked, they looked at our numbers, and they said, no, we can't. I said, why? And they said, well, we sell newsletters about gold based on fear. You sell gold investment advice based on greed. And we have no idea how to tell investors, hey, you can make money in gold. If you want to write about how Hillary Clinton's going to make you all use the same bathroom, we can market your newsletter. But if you want to talk about how people can make money in gold, we can't market that effectively. And that was 1993, and the same is true in 2022. The Treasury is not going to collapse. There's a prominent newsletter writer, 200,000+ subscribers, massive crowds when he speaks. His first newsletter in 1981 was that the Treasury was about to collapse. He's still saying the Treasury is about to collapse. Someday he probably will be right. The stock market's not going to collapse. It might fall 10% more. It might fall 20% more. You know, 2 weeks ago I wrote, hey, the stock market hasn't been this low since March. Last week I wrote, hey, the stock market hasn't been this low since March of 2021. It could go a lot lower, and then it'll come back, because that's what markets do. And hyperinflation is not coming. Let's see if I have a chart. Hyperinflation's not coming. Hyperinflation, as economists know it, is like 50% inflation. As I said, in the 1870s, when we were on a gold standard, we had bouts of high inflation, 20% for a year or two. But we've never seen hyperinflation in the United States. During the 30s and 40s, we had some periods of high inflation, but it was like 15 or 20%. And it lasted a couple years during the Great Depression. In 1979, 1982, we had a period of time when inflation was 7 to 14%. 14%. Not 50%. And it lasted a few years. Now we have, in the last 15 months, seen consumer prices go over 2% year-over-year change, getting up to 8.5% in the last 15 months. And it's coming down because of the arithmetic nature of the consumer price index. It's not hyperinflation. It's just not coming. If you're worried about these things and you're buying gold, you're going to be like the guys who send letters to some of these gold marketing groups saying, "Dear Peter, I've taken your advice for 40 years, and my children have asked me, they've begged me to stop taking your advice because I missed the 2 biggest stock market rallies in history and the 2 biggest bond market rallies in history, and I am squandering their inheritance. So I respectfully have to stop taking your investment advice." Things that gold will not do for you. It will not give you a stable purchasing power. It does not move against the dollar. Let's look at some charts. This is money supply versus inflation. You can see from 1977 onward, with the green line, various periods of time where money supply spiked sharply higher, 14%, 15%, 20%. And each time investors raced into gold thinking that it was going to be hyperinflationary, and the red line is inflation, which moves steadily sideways to lower. Now, growth in money supply this time around blows those other things off the chart. But you can see that the growth is already back to more normal levels. And you can see inflation has doubled, tripled, quadrupled from 1.2% to 8%, probably on a temporary basis. Monetary largesse has projected 8 of the last 1 periods of high inflation. I hear this is the greatest, deepest recession since the Great Depression. It's not. 1947 was actually a very deep but brief one-year recession. But look at where we were last in 2020 in terms of our recession, negative 3%. And then look at the 12 years of the Great Depression, where we were 7% contraction, 8% contraction, 14% contraction. Yes, it's the deepest recession since it was the deepest recession since 1947. But on a scale of 1 to 14, it was 3. Don't be so afraid. And then again, inflation. You can see those bouts of inflation in the 70s. 7%. We had 12 years where inflation was 5 to 14%. That's a long period of high inflation. And it led to some major changes in monetary and fiscal policies. The fiscal policies are still broken. The monetary policies have improved. And then we got into this period of much lower inflation, which persisted into the second quarter of last year. And now we are, as I said, 15 months into a period of higher inflation. So we have a long way to go before we have to worry about the kind of persistent high inflation that we saw in the 70s, which monetary authorities have learned how to fight against. Fiscal authorities haven't, and other things. Gold has outperformed U.S. equities in the long run. These are stocks and bonds going back to 1968 when the gold price was. And you can see the top blue line is the nominal gold price change indexed to 1968 as very strong. And the light blue line is the nominal S&P. So you can see that gold has outperformed the S&P by a factor of 50%. Then you look at the real inflation-adjusted things, and it's the same thing. Gold is a really good investment. It's just that no one will tell you that for the right reasons. They only try to sell it to you on fear. Now, real gold prices have not been stable, nor are they constant. The golden constant is a myth. On the left-hand side, you see prices since they were freed in 1968. And the real inflation-adjusted price, the purchasing power of gold, has fluctuated basically between 100 and 800. It's not exactly stable purchasing power. There were times when you could buy a really nice suit for an ounce of gold. There were times when you could buy 2 really nice suits for an ounce of gold. And there were times when you could get the hem on a leg, pants leg. The right-hand side shows you the gold price going back to 1700. And we had to use the British price because the US dollar didn't exist until the 1780s. And you can see that adjusted for inflation, using today's price, the gold price was equivalent to $5,000 an ounce in 1700. And Adam Smith in 1776 in The Wealth of Nations said the price of gold has already fallen 10% over the last 70 years, and it's going to fall further and then he gave a variety of reasons. And he was right. So gold is not a constant source of purchasing power. It fluctuates, it protects. I've got 1 minute, and you can go to our website and learn about us. 1 minute, one question? Any questions? Okay, well then, thank you.